Imagine finding a stock trading at just $4 per share that Wall Street analysts believe could nearly triple to $11 in the next 12 months. We're not talking about some speculative tech startup. This is a real infrastructure company that operates freight railroads, deep water ports, energy terminals, and power generation facilities across North America. A company generating over $330 million in annual revenue with hard assets that include 1,630 acres of deep water port on the Delaware River and 6 operating freight railroads. Here's what makes this opportunity particularly compelling right now. Despite just reporting a 54% quarter-over-quarter surge in adjusted EBITDA to $70.9 million, this stock has been absolutely crushed, down over 50% from its 52-week high of nearly $10. The stock is currently trading around $4, yet analysts have an average price target of $11.33, with some projecting it could reach as high as $13. That represents potential upside of over 180% from current levels. What's even more interesting is that this company just completed a major acquisition of the Wheeling and Lake Erie Railway, adding significant rail infrastructure to their portfolio. Their Long Ridge Energy facility is now producing excess natural gas for sale, opening up new revenue streams. And management is evaluating strategic alternatives, including potentially selling assets at valuations that could unlock massive shareholder value. Sometimes the best opportunities come when infrastructure stocks get unfairly punished, and this could be one of those rare moments. But before I reveal which infrastructure play I'm analyzing today, if you're new to smart investing, welcome to the channel. I specialize in finding undervalued stocks and hidden opportunities that most investors are overlooking. I do the deep research and fundamental analysis so you can make informed investment decisions based on real data, not just market noise. If you want to discover more high-potential opportunities like this before they explode higher, make sure you hit that like button and subscribe to Smart Investing. New videos are posted regularly covering the best stock opportunities across all sectors. Now, let me show you which beaten-down infrastructure stock could be ready for a major comeback. The company I'm talking about today is FTAI Infrastructure Incorporated, trading on NASDAQ under the ticker symbol FIP. FTAI Infrastructure is an infrastructure investment and operations company that acquires, develops, and operates critical infrastructure assets across the transportation, energy, and industrial sectors throughout North America. Founded in 2021 as a spin-off from FTAI Aviation and headquartered in New York, FTAI Infrastructure focuses on assets with high barriers to entry that generate stable cash flows. The company operates through 5 key segments: railroad, Jefferson Terminal, Repauno, power and gas, and sustainability and energy transition. Think of them as the behind-the-scenes owners of the critical infrastructure that keeps American commerce moving, the railroads that transport freight, the terminals that handle oil and refined products, the ports that enable international trade, and the power plants that generate electricity. Here's where FTAI Infrastructure becomes a really intriguing investment opportunity. This isn't just another infrastructure company. They're strategically positioned in sectors with massive barriers to entry and long-term competitive advantages. Their railroad segment now includes 7 freight railroads after the recent acquisition of Wheeling and Lake Erie Railway. This acquisition is already showing results, with volumes and revenues up approximately 10% and EBITDA up 20% compared to pre-acquisition levels. Railroads are incredible assets because once you own the tracks and right-of-way, you essentially have a monopoly on transportation in those corridors. Competitors can't just build parallel tracks. The capital costs and regulatory hurdles are enormous. The Long Ridge Energy facility is emerging as a standout performer. In Q3 2025, it generated $35.7 million in adjusted EBITDA with an impressive 96% power plant capacity factor. Even more exciting, they commenced natural gas production in West Virginia in August, creating a new revenue stream from excess gas sales. Management is now evaluating strategic alternatives for Long Ridge, including a potential sale. Given that energy infrastructure assets typically trade at high multiples, a sale could unlock significant value for shareholders. Their port assets are equally impressive. The Jefferson Terminal is a multimodal crude oil and refined products facility with stable performance. The Repauno port spans 1,630 acres along the Delaware River with an underground storage cavern, multipurpose dock, and rail-to-ship transloading capabilities. They've secured contracts and letters of intent representing approximately $80 million in potential annual adjusted EBITDA. The Q3 2025 earnings results tell a story of operational momentum despite a disappointing headline number. The company reported revenue of $140.6 million, up an impressive 68.7% year-over-year, though it missed analyst expectations by 4%. More importantly, adjusted EBITDA surged 54% quarter-over-quarter to $70.9 million, demonstrating strong operational leverage as they scale their assets. The Wheeling and Lake Erie Railway acquisition closed on August 25, 2025, and it's already contributing meaningfully to results. This is exactly the type of acquisition FTAI Infrastructure excels at, buying underperforming infrastructure assets and improving their operations and profitability. The company declared a quarterly dividend of 3 cents per share, payable November 28, 2025. While the yield is modest, it demonstrates management's confidence in cash flow generation despite the significant investments they're making in growth. Looking at analyst sentiment, the consensus is strongly bullish. All three analysts covering the stock rated a strong buy, with an average price target of $11.33. Citizens JMP has a $12 price target, reflecting confidence in the company's strategic direction under CEO Kenneth Nicholson. Currently trading around $4 per share, FIP presents a compelling risk-reward opportunity for investors willing to look past near-term noise. The average analyst price target of $11.33 represents 183% upside, with the range spanning from $9 to $13 per share. Several catalysts could drive the stock significantly higher. First, the full integration of Wheeling and Lake Erie Railway should continue boosting EBITDA as operational synergies are realized. Second, a strategic sale of Long Ridge could unlock substantial value. Energy infrastructure assets are highly sought after by private equity and strategic buyers. Third, the new contracts at Repauno representing $80 million in potential annual EBITDA could transform that segment's profitability. If the company executes on these opportunities and continues growing EBITDA while improving margins, I could see the stock reaching $8 to $10 by late 2026. That represents 100% to 150% upside from current levels. In a bull case scenario where they successfully sell Long Ridge at a premium valuation and continue adding value-accretive rail assets, the stock could approach analyst targets of $11 to $13, representing over 175% potential gains. The key risks include execution challenges integrating the Wheeling acquisition, regulatory hurdles that could delay projects, and the significant debt load of approximately $3.7 billion. However, with strong EBITDA growth and hard infrastructure assets as collateral, the debt appears manageable. There you have it, FTAI Infrastructure, a beaten-down infrastructure stock with real assets, growing cash flows, and massive analyst support trading at what appears to be a significant discount. With railroads, ports, terminals, and energy assets that are incredibly difficult to replicate, this company has built-in competitive advantages that should drive long-term value creation. What do you think about FIP? Is this infrastructure play on your radar? Would you buy at these levels or wait for more proof that the turnaround is working? Drop your analysis in the comments below. I read every single one and love hearing different perspectives from this community of smart investors. If you found this deep dive valuable, don't forget to smash that like button and subscribe to Smart Investing for more undervalued opportunities like this. Turn on notifications so you're the first to know when I post my next video. Remember, this content is for educational purposes only and not financial advice. Always do your own research and consult with a financial professional before investing. Thanks for watching, and I'll see you in the next video.